Welcome to the deep dive. Today, we are taking a granular look at a company that is, well, it's challenging everything we thought we knew about industrial
We're
stocks.
talking about Eaton Corporation, ETN.
And it is arguably one of the most intriguing transformations happening in the industrial landscape today.
Oh, absolutely. I mean, for over a century, Eaton was defined by heavy machinery.
Right. Truck axles, gearboxes, that kind of thing.
Exactly, hydraulics.
Yeah.
A classic cyclical conglomerate.
Mm.
Our mission today is really to cut through the noise and figure out how this company, founded back in 1911, became this mission-critical intelligent power manager.
The central nervous system for the next generation of the grid and especially data centers.
That's it.
And the reason this dive is so essential, I think, is the central conflict you see in its valuation.
Mhm.
Traditional industrial firms, they often trade in the low to mid-teens on an earnings multiple. Eaton is currently trading at a forward PE ratio of over 34 times. Yeah.
It's a tech multiple. The market is valuing it like a high-growth technology platform, not a century-old manufacturer.
So we have to identify the structural, the non-cyclical drivers that could justify such a dramatic re-rating.
Absolutely. And when you look closely, you realize this isn't just luck. This is the result of really 2 decades of strategic focus that's converging right now with what management calls a super cycle.
And what are the components of that?
Well, they are sitting at the confluence of 3 massive secular shifts. First, the deep electrification of, well, everything.
Homes, transport, you name it.
Second, the huge reindustrialization of Western economies,
Oh.
Reshoring supply chains. And third, the exponential increase in power demand driven by digitalization and, of course, generative AI.
Okay, so let's unpack that structural transformation first. You don't just wake up one morning and become the power source for the modern grid.
No.
What was the groundwork that allowed them to shed that legacy industrial skin?
It was a brutal, and I mean brutal, simplification of the corporate architecture. It required just a ruthless focus on margin expansion and return on capital.
So they were divesting major businesses.
Systematically. Things like their global lighting business and, most notably, the heavy, very cyclical hydraulics segment. That wasn't just a small cleanup.
No, that was tearing out the foundations and rebuilding the house. Hydraulics was a cornerstone of the old Eaton identity.
It was. Selling that signaled a profound change. The result is that today, roughly 70% of Eaton's revenue flows from the electrical sector.
A huge shift from its diversified past.
It was all about optimizing for assets with stronger IP, less cyclicality, and, significantly a higher margin potential. They prioritize earning $1 of high-quality revenue over $3 of low-margin revenue.
And the financial metrics? They really bear that out. We've seen record earnings, but it's the margin expansion that's the real story.
It is. They guided for record earnings per share of $9.50 for 2024 and have already accelerated their 2025 organic growth guidance into the high single digits.
We're talking 7.5 to 9.5%.
But the structural evidence, the real proof, is in the segment operating margins hitting a record 25% in recent quarters.
25% for an industrial manufacturing business is just a masterclass in operational leverage.
It is. They are moving high-value product through their existing factory footprint, and it's driving massive efficiency.
But margins can be fleeting, right? Especially during a boom cycle when demand just outstrips supply. How do we know this quality is durable?
That's the key question.
How do they stop the management team from falling into that classic empire-building trap that ruins so many conglomerates?
And this is where governance comes in and really separates them from their peers. The board has fundamentally aligned long-term management compensation,
Their stock awards.
specifically their performance share unit awards, directly to return on invested capital, ROIC.
So explain why that's the magic lever here. Why is linking compensation to ROIC so important?
Well, when we talk about ROIC, we're talking about how much profit the company generates for every single dollar of capital they invest. For a lot of heavy industrials, the goal was just to hit the cost of capital, maybe 8 to 10%.
Which is just break even in economic terms.
Exactly. Eaton demands that management only deploys capital, whether it's M&A or new factories. If it generates economic profit above the cost of capital, every move has to add true value.
So no acquisitions just for size.
It prevents that. They have to increase shareholder value. And the results, they really reflect this discipline.
You can see it in the numbers.
Oh, absolutely. Eaton has transformed its returns on invested capital from around 10%, which is basically industry average.
To consistently running in the mid to upper teens For a company of this scale, that transition is monumental.
It is. It's what structurally differentiates their earnings profile, and it's what starts to justify that premium valuation.
And we also see continuity in leadership.
A smooth transition. Craig Arnold, the architect of this, transitioned the CEO role to Paulo Ruiz this year, and Ruiz has explicitly committed to maintaining that operational intensity.
Okay, so with that foundation set, let's pivot to the growth engine. The crown jewel, Electrical Americas. And there's one acronym dominating that sector.
AI.
This is where the physics shift makes Eaton indispensable. What is happening in the data center world that suddenly makes power the main constraint?
It's a geometric leap in energy density. I mean, if you look back just a few years, a standard server rack in a data center might draw 5, maybe 10 kilowatts of power. That was the norm.
Okay.
But the new AI training clusters stuffed with thousands of GPUs are consuming vastly more. We're now seeing requirements of 50 kilowatts, 80 kilowatts.
Sometimes even 100 kilowatts per rack.
Especially with liquid cooling coming online.
So scaling AI is no longer a question of buying more chips. It's a question of buying more electricity and being able to manage it.
Precisely. The bottleneck has shifted from silicon to power delivery. If you are a hyperscaler, a Microsoft, an Amazon, a Google, your biggest constraint is getting enough clean, high-density power into your facility.
And that's where Eaton comes in.
They provide the gray space infrastructure, the massive switchgear, the specialized transformers, the uninterruptible power supplies, or UPS, that condition and distribute that intense power load.
Right up to the server row.
And this data center business is projecting around 50% annual growth through 2025. I mean, that's just phenomenal.
That kind of growth demands speed. Eaton seems to be adapting, moving away from just selling individual parts to
offering full turnkey solutions.
Yeah.
And that speed is critical for winning those hyperscaler contracts. A perfect example is their $1.4 billion acquisition of Fiberbond.
And what did they do?
They specialize in pre-integrated modular power enclosures. Think of them as giant factory-built power rooms.
So instead of building it all on site.
Exactly. Instead of trying to construct and wire a complex power room on a dusty construction site, which takes forever and requires scarce skilled labor,
They just build the whole thing in a factory.
they build the entire unit off-site as a complete skid. They ship it, drop it into place, connect the utility line, and you're ready to go.
So they are industrializing the construction process, directly bypassing the huge shortage of skilled on-site electricians. That's a massive competitive edge.
It totally transforms the speed of deployment. And they're also pushing the tech envelope with acquisitions like Resilient Power Systems,
Which brought in solid-state transformer technology.
a crucial leap. Traditional transformers rely on heavy copper windings. Solid-state transformers replace those with power electronics. They're smaller, more efficient, and produce less waste heat.
Which in a data center is incredibly valuable real estate.
Absolutely.
Let's shift gears slightly. AI is the tech driver, but the broader Electrical Americas business has a powerful, non-technological moat, federal policy.
Yes, the IIJA and the IRA.
The Infrastructure Investment and Jobs Act and the Inflation Reduction Act.
The policy tailwind is huge, and it creates a genuine competitive barrier. Both acts allocate billions for grid modernization and clean energy, but they come with stringent domestic content requirements.
And restrictions on foreign entities.
Right. For projects to get the maximum tax credits, they have to meet these escalating domestic preference thresholds. For instance, a 45% threshold for projects starting in 2025.
So if you're an international competitor relying on imports,
You're effectively locked out of the most subsidized, highest growth projects in the U.S.
it forces localization.
Exactly. And it gives a sustained advantage to companies with established domestic manufacturing, like Eaton. Their $340 million investment in a new transformer facility in South Carolina.
That's a direct response to this.
That's a tangible response to this policy-driven demand. This in the region, for the region, strategy is a powerful moat.
Okay, so we've got the premium hardware and the policy moat. Now let's tackle the software layer that really cements that high-tech valuation.
Right.
How does Eaton stop all this expensive equipment from eventually becoming a commodity?
They mitigate that risk with their Brightlayer platform. This is their software ecosystem. The goal is to transform passive hardware into an active, connected, indispensable network asset.
So you're not just selling a circuit breaker.
You're selling a connected node that constantly generates data and can be monitored and managed remotely.
Which turns a one-time hardware sale into a recurring relationship. You're building industrial switching costs.
That is the key. We call that sticky revenue. Once a mission-critical facility, a hospital, a data center, is running their intelligent power manager software for visualization, for cybersecurity, for predictive maintenance,
It becomes an operational nightmare to rip it out.
the operational risk and the cost of switching are just too high.
Can you give us an example of how that software feeds back into hardware sales, that virtuous cycle?
Sure, look at the Elevate Tech Group case study. They're a managed service provider that used the software to oversee client power systems remotely.
Okay.
The software's data identified systemic issues, revealing that 60% of their client sites had UPS systems nearing end of life.
And because the management platform was already embedded?
Eaton became the default, trusted provider for that hardware refresh. The software directly drove millions in high-margin hardware replacement sales.
That is the holy grail, leveraging data to create predictable, recurring hardware demand. Now, before we get to risks, what about the other two segments?
Right, aerospace and e-mobility. Aerospace is the definition of stable ballast. Once a component is certified for an aircraft, its life cycle is 20 to 30 years.
So you get decades of high-margin, recurring aftermarket revenue.
It's stable, predictable cash flow, and it's well-positioned for the more electric aircraft trend.
And e-mobility is the internal venture bet.
Correct. High risk, high reward. They're smartly avoiding the battery competition and focusing on specialized power electronics for commercial vehicles. Their key innovation is the breaker.
A new kind of circuit protection.
Right. As EVs move to 800-volt architectures for faster charging, especially in heavy trucks, they need a sophisticated protection system that old fuses just can't handle. That's the bet.
All right, time for the necessary cold shower. We've established the merit of the business, but we have to address that 34 times PE ratio. The market is pricing in perfection. Assuming these 8 to 9% growth rates will persist for years, what's the fundamental risk here?
The primary risk is multiple compression. This valuation demands flawless execution. If growth decelerates even slightly, say back towards a standard industrial rate of 3 or 4%,
The market will derate the stock.
inevitably, going from 30 times earnings to 20 times earnings, even if the underlying business is fine, would trigger a painful drawdown. You're paying a premium for growth that has to be delivered.
And the most specific cyclical risk is tied to their core driver, the AI CapEx air pocket.
This is critical. The data center expansion is highly concentrated among a few massive hyperscalers. Their spending is nonlinear. It comes in huge waves.
So the risk is they enter a digestion period.
Exactly. They pause new construction to optimize the huge capacity they just deployed. Given the concentration in Eaton's backlog, that kind of pause poses a significant near-term risk.
And we noted that execution on this record backlog isn't necessarily flawless. We saw some employee reviews pointing to internal friction.
That is the double-edged sword of high demand. Managing a record backlog of custom orders can strain internal resources. We saw reports citing a huge issue with organization and communication.
And for those complex, custom modular data center projects, that could be a real problem.
It could absolutely hinder execution, delay revenue, and damage relationships with hyperscalers who demand speed above all else.
And finally, we can't completely discount the macro environment.
No, you can't.
They still sell into commercial construction outside of the data center bubble.
That's true. While data centers are somewhat insulated from rising rates, the rest of their portfolio, traditional commercial buildings, offices remain sensitive to a higher for longer interest rate environment. That segment could act as a headwind.
So synthesizing everything we've uncovered, the transformation, the AI engine, the policy moat, and the risks,
Yeah.
what's the final verdict? Is this structural shift truly permanent?
I believe the verdict is that the shift is structurally real and, yes, permanent. Eaton is no longer a heavy industrial commodity supplier. They have successfully transitioned to an indispensable, sticky partner for global electrification.
And the premium.
The premium is justified because they have fundamentally reset their earnings potential. You can see it in the durable transformation of their returns on invested capital from industry average to the high teens. They're a utility-like asset with tech-like growth potential.
It's a compelling blueprint for how a legacy manufacturer can reinvent itself by capturing that critical choke point power delivery.
Absolutely. Yeah. The concept I want to leave you with, building on that Fiberbond acquisition, is this: the modular revolution.
Okay.
Eaton's move toward pre-integrated factory-built electrical infrastructure suggests a profound shift. I think you should ponder how this trend-moving complex construction from the chaotic job site to the efficient factory floor isn't just an electrical story, but a trend that's set to reshape productivity across almost every major industrial construction sector in the decade ahead.